Hello and welcome. You're watching ET Markets. I'm Tanya Aneja, and today we are going to talk about an error which could lead to a huge loss for the one initiating the trade and a windfall gain for others. Well, we are talking about fat finger trade. Last week, the derivative segment on the National Stock Exchange witnessed a fat finger trade in the weekly Nifty 50 options contract, resulting in a loss of nearly 200 crore rupees for the trader. So to discuss this error in detail, I'm going to be joined by a very special guest. I have with me Mr. Ambareesh Baliga, who is a market veteran and who will tell us more about this error. Thank you so much, Mr. Baliga, for joining us on ET Markets today.
Thank you, Tanya, for having me.
So what is a fat finger trade exactly? And is it the biggest trading mistake that has ever been witnessed in India?
See, fat finger literally means that you punch the wrong key. And we normally do that whenever we are sending WhatsApp messages or emails. But then that doesn't end up with a huge loss. But in market scenario, if you end up with a fat finger, which means you're doing a transaction which goes wrong. For example, if you have to buy and instead of that you press the sell key, or say you want to sell stock at 900 and instead of 900 you punch 800, or you want to sell 1,000 shares, you end up selling 10,000 shares. This sort of a mistake results in a huge loss for the brokerage or the client, whoever it is. So this is called fat finger. You make a mistake, and because of that mistake, you end up incurring a huge loss. And at times, if this mistake is huge, like what we saw a couple of years back, or even recently, what we saw a couple of years back was when, because of this fat finger, the whole market came down. And in the recent past, whatever fat finger trade which you saw on the NSE, the brokerage lost about 202 crores.
Okay, so what exactly happened in the derivative segment, if you could explain it in detail?
Out there, when the Nifty is quoting at about, say, 16,000, the 14,000 call is in the money, in the sense it has to quote at a minimum of 2,000 plus, because that 2,000 is already built in, because it is in the money. We call that in the money for the call. So the dealer should have, in case he was selling the call, he should have been selling it at 2,000 plus. Instead of that, he sold it at 15 paisa.
Okay.
So once the deal was done, they needed to cover, or it gets covered at 2,000 plus. So that is the sort of a difference which the dealer or the brokerage house had to pay.
Okay, and also the question is, Mr. Baliga, that even if the broker system had failed, NSE's risk management system should have been robust enough to check this huge error. With prices so far off from the ruling market level, how could such trades hit the trading engine?
No, there are circuit levels. There are circuit levels for stocks. There are now circuit levels for index, as well as the last time there was an issue with MK Global when they sold the Nifty. This was in October 2012. When they had sold the Nifty, it was a erroneous sort of an order, which resulted in the markets coming down. And from then, we have a sort of a circuit as far as the futures are concerned. But when it comes to options, like what happened a couple of days back, the call and put options, in that, there's a sort of a like an upper level or a circuit for at the upper level, but not at the bottom level. So you can still sell a call or a put at 5 paisa. So here what happened was, although it should have been quoting at 2,000, or it should have been sold at 2,000 plus, since that whole thing was open till 5 paisa, they sold it off at 5 paisa.
Okay, and also how to neutralize fat finger trades from hitting the trading engine, and how do such trades get fixed?
No, basically I think it has to be, the dealer has to be extremely careful. That comes from experience. At the same time, one needs to be extremely careful when you're punching in the trade. But beyond that, when there's a lot of pressure, it's possible that you could have a fat finger, and because of which your systems need to take care of such sort of mistakes. So, I mean, you have two levels of check. The first level of check is at the broker level, where the broker system should be robust enough to take care of such mistakes. And then finally, in case the broker level fails, then at the exchange level, this sort of checks and balances should be there. So now I think after this mistake which has happened, we'll have to see as to what NSE does going ahead to avoid such sort of issues.
Okay, and lastly, this is not something new, right? Earlier also fat finger trade led to like big fat losses in India as well as abroad.
Absolutely. Like I said, the earlier one was at MK Global,
Okay.
where Nifty was sold, and because of which, it affected the market overall. Here, it was only call which was sold, so it did not really have an effect on the markets overall. But when you are selling Nifty at a throwaway price and a huge quantity, it affects the market because there are arbitrage players. Because if the Nifty comes down, you cannot have all the other stocks holding on because the arbitrage players come in, and because of which the markets crashed that day. I mean, that is as far as India is concerned. And globally, we have seen this happening quite often. Even like last month, Citigroup had a fat finger trade, which ended up losing about 50 million for the bank. And there have been stories about South Korean Samsung Securities. They had mistakenly allotted about 2.8 billion shares to the company's employees instead of giving them a dividend of 2.8 billion. So these sort of mistakes keep happening. But then one has to see as to how this can be corrected or reversed to a certain extent. Whereas what we've seen in the past is that NSE has not reversed even this time. What they have done is they have held back the payouts for two or three major brokers who had made money because of this mistaken trade. Whereas I think the smaller brokers or the other investors who had gained because of this would have got the payout.
Absolutely. On that note, Mr. Baliga, thank you so much for explaining it so well. And thanks again for taking your time out and talking with us on ET Markets.